Investing can be a powerful way to grow your wealth, but it also comes with risks. The good news is, there are proven strategies to help you protect your investments and minimize those risks. Today, we'll walk through some of the smartest ways to reduce investment risk and safeguard your financial future. Reducing investment risks involves strategies that help investors protect their capital and minimize potential losses. Imagine you've worked hard to build your savings, but the idea of losing it in a risky investment makes you hesitant. What if you could invest and sleep easy, knowing your capital is protected? The key lies in diversification. By spreading your investments across different asset classes, stocks, bonds, real estate, and even alternative assets like gold or crypto, you reduce the impact of any single asset's poor performance. It's like having a safety net for your portfolio. Next, consider doing deep research. Understanding the companies, markets, or funds you're investing in gives you an edge. The more you know, the better equipped you are to avoid unnecessary risks. Another smart move is to set stop losses. These automatic sell orders kick in when an investment drops to a certain price, preventing further loss. It's a disciplined way to protect your portfolio from big swings. Think long term. Markets fluctuate, but over time, good investments tend to recover and grow. If you're constantly buying and selling based on short-term movements, you're likely to face losses. Patience often pays off. Never invest more than you can afford to lose. This simple rule ensures that even if things don't go as planned, you're not in financial trouble. Reducing investment risk is crucial for protecting your capital and maximizing returns. When you spread your investments across different asset types, such as stocks, bonds, real estate, and even commodities, you reduce the impact of any single asset underperforming. This creates balance in your portfolio. Another important strategy is risk assessment. Always understand the level of risk you're taking on with each investment. Research the companies, sectors, or funds you're putting your money into. Knowledge is power, and being informed can help you avoid unnecessary risks. Consider setting stop-loss orders. These automatically sell an asset when its price drops to a certain level. It helps you manage downside risk, protecting your portfolio from large losses in volatile markets. Consider customizing your asset allocation based on your personal risk tolerance and investment goals. A balanced mix of equities, bonds, and alternative assets can help create a portfolio that's resilient to market fluctuations. Investing in low-cost index funds is another way to reduce risk. Index funds provide broad exposure to entire markets, lowering the chance that one underperforming stock could hurt your returns. Additionally, dollar cost averaging is a technique where you invest a fixed amount of money at regular intervals, regardless of market conditions. This strategy helps smooth out the effects of market volatility over time. Rebalancing your portfolio is essential to maintain your desired asset allocation. Over time, market movements can throw your portfolio out of balance, exposing you to more risk than you originally intended. Rebalancing brings everything back in line and ensures that no single asset class dominates. You might also consider using options to hedge your portfolio. For example, buying put options can protect you from downside risk while still allowing you to benefit from market gains. Another way to reduce risk is by focusing on defensive stocks, like those in industries such as utilities, healthcare, and consumer staples, which tend to perform well even in downturns. Dividend-paying stocks can provide both stability and income. Companies that pay regular dividends often have stronger financials, and their steady income streams can help mitigate losses during volatile markets. Bond laddering is another risk-reducing strategy, where you purchase bonds with staggered maturities. This spreads out interest rate risk and provides a reliable stream of income. International diversification can help protect you from country-specific risks. By spreading your investments across global markets, you reduce your exposure to the economic and political factors affecting any one region. Blue-chip stocks are another safe bet. These large, well-established companies tend to have solid track records and are generally less volatile. Real assets like real estate, commodities, and infrastructure investments can also offer protection. They often perform well in inflationary environments and provide a different type of diversification compared to traditional stocks and bonds. Leverage, on the other hand, should be used cautiously. Over-leveraging can amplify losses, so it's best to borrow sparingly when investing. Seeking professional guidance can also be helpful. A financial advisor or robo-advisor can construct a diversified portfolio tailored to your needs, reducing your risk while still aiming for growth. In addition to investments, having an emergency fund is crucial. A cash reserve allows you to avoid selling assets at a loss in times of need. Avoiding emotional decision-making is key to reducing investment risk. Panic selling during a market downturn or getting caught up in the excitement of a bubble can lead to poor outcomes. Maintaining discipline and sticking to your investment strategy will help you weather market volatility. Low volatility funds are designed to limit price swings, offering a more stable investment option. Limiting sector concentration also helps reduce risk. If all your investments are in one industry, like technology or energy, a downturn in that sector could severely impact your portfolio. Investing in quality is another way to protect yourself. Focus on companies with strong balance sheets, consistent earnings, and proven growth. They tend to perform better during tough market conditions. Tax-efficient investing is another consideration. Using tax-advantaged accounts like IRAs and 401(k)s allows your investments to grow without the immediate impact of taxes, boosting long-term returns. When entering the market, consider staggering your investments rather than committing all your capital at once. This approach, often called staging, spreads your entry points over time, reducing the risk of buying at the market's peak. Combining these various strategies can significantly lower your investment risks and help you build a more resilient portfolio designed to thrive even in unpredictable market conditions. If you found this video helpful, make sure to like and share it, and subscribe for more insights on growing your wealth with confidence. There are several types of assets that offer more stability and predictability. One of the most popular choices is government bonds. These are typically backed by the full faith of the government, making them one of the safest investments available. Treasury inflation-protected securities, TIPS, are another bond option that protects against inflation. Mutual funds and exchange-traded funds, ETFs, that focus on broad market indexes, such as the S&P 500, are also less risky compared to individual stocks. They provide diversification, reducing the impact of any one stock's poor performance on your portfolio. Dividend-paying stocks from well-established companies are generally more stable as well, since they offer regular income even in volatile markets. For those who prefer fixed income, corporate bonds from large, financially stable companies can be a good option. While they carry a bit more risk than government bonds, they offer higher yields. Real estate investment trusts, REITs, allow you to invest in real estate without owning property directly, providing a steady income stream and potential for long-term appreciation. Money market funds are another low-risk choice. These funds invest in short-term, high-quality debt and are designed to offer a higher return than savings accounts while maintaining liquidity. High-yield savings accounts provide a risk-free way to grow your cash, and they are typically insured by the government, which guarantees your deposits up to a certain limit. Certificates of deposit, CDs, are also safe investments for beginners. They lock in your money for a specific period in exchange for a fixed interest rate, which can be higher than a regular savings account. Municipal bonds, issued by local governments, offer tax advantages and are generally safer than corporate bonds. For those interested in more tangible assets, precious metals like gold and silver are considered safe havens during economic downturns. They tend to hold their value or even increase in price when other assets decline. Similarly, investing in defensive stocks, which are companies that provide essential goods and services, offers more stability since these companies typically perform well in any economic environment. Target date funds are another beginner-friendly option. These are designed to automatically adjust their asset allocation to become more conservative as the investor approaches retirement. Low volatility ETFs focus on stocks with historically less price fluctuation, offering a safer way to invest in the stock market. Annuities can provide guaranteed income for life or a set period, making them a reliable option for risk-averse investors. Additionally, U.S. savings bonds offer safety and steady returns, backed by the government, and are a popular choice for conservative investors. Finally, index-linked CDs combine the safety of certificates of deposit with the potential for higher returns linked to a stock market index, offering upside potential with less risk. By following these strategies, you can effectively minimize risks while working toward your financial goals. By applying these strategies, you can build a stronger, more resilient portfolio that stands the test of time. Remember, smart investing is about balance and long-term thinking. Before you go, don't forget to like this video if you found it helpful. Subscribe to the channel for more tips on growing your wealth and reducing financial risks. Share this with anyone who could benefit from smarter investing strategies. And while you're here, check out this next video for even more insights.